not being together and enjoying lunch and casual conversations as usual, but in the midst of this pandemic, we know that this is our new way of meeting, as we have said. Seems like we Zoom all day long now, right? So a lot has changed since our January meeting, and we again hope that you and your loved ones are staying safe during this difficult time. And before we get started with our market update provided by Dave Smith at Marquette Associates, we wanted to provide just a couple quick updates on our foundation and our role during this COVID-19 response. So first of all, 7 of our 12 staff are still working remotely, and that's going very well. We were well prepared with technology and other resources to make that a pretty seamless process. Liz, Nikki, Jenna, Tom, and myself have remained in the office, and our community space is closed for now anyway. But having some staff in the office has certainly been a blessing to us as we've continued our operational responsibilities, as well as opening 12 COVID-19 response funds across our region. And this does include opening a collaborative fund that many Blackhawk County funders contributed to, and we're really proud of that work. Together, we've raised nearly $350,000 in Blackhawk County alone, and of that, we've granted out $275,000, and primarily that's focused at nonprofits that are providing those services in direct response in the most urgent ways. So certainly our foundation has strengthened its role as a community leader and a convener through this response, and we're just really proud of those efforts. And we just feel like we are blessed to be a part of this important work that really does provide community members that opportunity to financially support the vital nonprofits that are on the front line of that response. So now I'm going to invite Terry Gomer to share with you a little bit about the work that we've been doing in our affiliate region as well. So Terry, I'll turn it over to you.
Okay, thanks, Kay. I'm going to just get on here and share my screen. Okay, that'll just come up there, sorry, still learning. So as Kay mentioned, the COVID-19 pandemic created a lot of challenges and opportunities for everyone. And almost immediately after the Blackhawk County COVID-19 Cooperative Disaster Response Fund was established, we began working with our affiliate partners just to determine where the local response funds were needed. And our goal was to provide a central point for donations that would then be used to support the organizations providing the basic human services to those populations most affected by the pandemic. Excuse me. We had a really great response from our initial calls with our affiliates, and then created 10 county-specific funds, and those are on the list there. And then we also had one regional fund that we created in collaboration with the United Way of North Central Iowa that covered their 6-county regional area. So from an affiliate view, we've raised about $214,000 in donations and have granted out about $114,000 to the nonprofit partners in the region. We're still receiving donations, and additional grants are still pending. So it's an ongoing process, and we're just addressing the needs as they're coming up and hoping that the communities are still making the donations to the funds. The majority of the affiliate grants have been for organizations. A lot of it has gone to providing food, emergency management, public health for PPE, and then the regional social welfare organizations. Another thing that we did to try to help the nonprofits was our programs team simplified the grant process to make it easier for them to get these COVID funds, and also suspended grant reporting, again, to lessen their burden. And our marketing team has been working throughout the region to promote the funds for donations and let the communities know the good work that's being done by their local and regional service agencies. So if anybody has any questions about the COVID funds, you can type it in the chat, and we can address those. Another part of the COVID-19 response has been working or with our professional advisors, has been having new opportunities for clients to make charitable gifts. So obviously the first option is to making gifts to our COVID-19 response funds. But the other need that is coming up pretty quickly is that the gaming dollars that normally support a lot of great programs in our region, in 17 of our counties, is now facing probably up to a 40% decrease in the allocation of funds for those counties. And this is going to have a huge impact on the local nonprofit agencies who really count on those dollars. So your clients can also give to that discretionary grant fund to help refill that bucket, if you will. Now, those dollars are not eligible for the Endow Iowa tax credit because they are in a fully expendable fund, but they are tax deductible. The Endow Iowa credits are, if they are important to your clients, we do have county impact funds that are eligible for the Endow Iowa credits. And just to give you a quick update on Endow Iowa, as you may know, the 2020 credits were actually expended as of December 26th of 2019. So we are creating the waiting list for the 2021 credits. And as of June 15th, about 2.5 million have already been put on that waiting list, leaving about 3.5 million, and we're only in June. So the credits are going quickly, and we anticipate that we will probably have expended the 2021 credits long before the end of 2020. So it's just something to keep in mind when you're doing your planning. So at this point then, I am going to turn that over to Nikki to talk about charitable giving.
And I know we were having some issues with sharing the document, so I forgot to let you guys know that we will be sending out a document that kind of wraps up all the facts and information that Terry, Nikki, and I are going to be sharing about internal operations and the COVID funds and things. So that will be coming to your inbox following the meeting. So sorry about those technical issues. So, okay, Nikki, I'll turn it back to you.
Okay, Terry, are you able to share your screen with us? There we go. Okay. So as Kay mentioned, we have a handout that we'll be sending out following today's seminar, but this is kind of a little one-sheeter that you can use as a tool as you're talking to your clients. And we have learned, as many of you may have, is that even though some clients may not normally be charitable, we've experienced some that have felt that they want to pivot a little bit and be charitable and try to help during this crisis. And so we put together a little checklist of things as your clients are thinking or talking about trying to be more charitable and they're making their estate plans. Here's kind of a list that we would suggest that you go through with them, and basically having a conversation about talking about the issues and causes that they're most passionate about. Because as this pandemic has affected everybody in some way, shape, or form, those charities and causes are definitely probably feeling some of the burden from this pandemic. And then help them prioritize those charities and causes. And then what charitable gifts have given them the most satisfaction? If they have given to a charity in the past, what brought them the most satisfaction and made them maybe warm their heart a little bit? And you know, I don't know if they have reached out to their charitable organizations and had that conversation about how those specific organizations have been affected. We've been, as a foundation, making those contacts, but maybe that's a suggestion for your clients to reach out to have that conversation with their favorite charity. And finding out what are the short-term needs and long-term needs. Since this COVID crisis has hit, those things probably have changed too. Priorities have probably changed. So having those conversations with your clients, if they know those questions, of course, and then how can they help them be ready for a future crisis? If something like this would happen again, or if we go into another phase of the pandemic, how can your clients help those charitable organizations be prepared for another future crisis? And of course, putting in a little plug for the foundation, and having that partnership with us and you can definitely refer to setting a meeting with us and you and them to talk about those things. We do have a lot of experience talking, especially even recently, with a lot of those nonprofit partners. And if they are open and willing, we can set a Zoom meeting like this. We could even meet at a distance in a big conference room and keep our 6-foot distance. So we are very, very happy to have the opportunity to join in those conversations as your clients are thinking about helping during this pandemic. We've, again, experienced that from a lot of our clients and donors who have asked how they can help. So we're happy to be a part of that conversation. So as I mentioned, we will be sharing this flyer with you. There's some other helpful information on that as well that we won't be touching on today, but this will be coming in a follow-up email along with Dave's information. We'll share that as well. Okay, now I'm going to introduce Dave, our speaker for today. And in light of the recent pandemic, our markets have been greatly influenced by this whole situation. And Dave Smith is a CFA with Marquette Associates. He is joining us to discuss the impact of COVID-19 on the markets. This is a follow-up discussion. We usually have an annual meeting in January to talk about a look ahead at the markets, and Dave can probably attest that things have changed quite dramatically from January. And he is the managing partner for Marquette Associates. He's an owner of the firm, and he has been with that company since 2009. And he serves as the lead investment consultant on several of the firm's relationships. So Dave is our expert in the field joining us today. And Dave, thank you for joining us. You can take it away.
Thank you, Nikki. And I am trying to share my screen. I had a tremendous amount of success with that about 15 minutes ago, and it doesn't look like I am sharing. There we go. Can we see this? Great. Nods of approval. Well, good afternoon, everyone. And Kay, team, thank you again for inviting me to offer perspective on markets and given the backdrop of COVID-19. I'm always excited and grateful for the opportunity to engage with the community, and certainly welcome the opportunity to see everyone in person, hopefully at the beginning of the year under different circumstances. And the intention here, as before, is to just offer additional perspective, share additional materials, and enable you to be better stewards of your clients' capital and help guide them and offer additional perspective. Please feel free to interrupt with questions. I think either using the chat function, I think that's probably the best way, or we can take on Q&A at the very end. But most of this information is based on, or is updated through the end of May, and takes into consideration really everything that's happened since the throes of the COVID crisis. Fortunately, the fears, the volatility, the lack of liquidity, much of that is in our rearview mirror. But I think we are all conscientious and well aware of accelerated equity market values and really what lays ahead. It's certainly great to see some sort of stock market recovery, but what's happening with the overall broader economy is a much different story than we're seeing in equity markets. And we are cautious about what can potentially lie ahead. So just to start off, I think it's important to remind ourselves of the frequency with which bear markets occur. Bear markets are part of equity market investing. Bear markets lead to volatility. Since 1950, we have had 10 different bear markets. In other words, we've experienced a bear market in US equities or large cap equities about every 7 years. Corrections, which is a sell-off of 10% or more, occur about every other year. Bear markets, a sell-off of 20% or more, occur on average every 7 years. But what is particularly interesting about this particular episode is the fact that we entered a bear market after reaching market highs on February 19th, just 16 trading days later, as evidenced in this one highlighted column. The average period to bear market since in the 10 previous instances is about 186 days, or a year and a half. And the reason I bring this up, we also see very positive signs of recovery. The number of days to recovery on average is around 580. And the average return following a trough of the bear market is 40%. So we do see, we've been through this before. Obviously, the circumstances that got us here are much different than the ones we've previously encountered, but this is part of equity market investing. The tremendous amount of financial, fiscal, and monetary stimulus that's been thrown at this crisis in the United States and sort of everywhere across the world really has driven equity markets back up. And for a very, very brief period last week, after a favorable but perhaps unrealistic unemployment number, we actually recouped all of the losses year to date. We've since given a little bit back up, but it's just a testament to how meaningful the overall monetary and fiscal stimulus has been in the U.S. and markets abroad. The odds of recession, and this is a chart that I think we look at probably every year. The odds of recession this time a year ago, based on the New York Fed, which is simply an evaluation of the yield curve, which at the time was inverted. Based on an inverted yield curve, we had a very high probability of entering a recession. Now, of course, we have entered a recession, but for reasons completely unrelated to an inverted yield curve. So the predictive power of that particular metric, the New York Fed yield curve chart, was accurate, but not really for the right reasons. We are now in a recession. We have been in a technical recession since February, and it's the first time that we've encountered 2 consecutive quarters of negative or contracting GDP since 2008. And this is coming off of one of the most robust periods of expansion in the last 100 years that lasted somewhere in the neighborhood of almost 130 months. So we had a very favorable economic backdrop until this hit. And of course, the outlook going forward is everyone knows, is not very favorable. We're expected to see across a number of different very large institutions economic contraction that ranges anywhere from sort of 7 at the most optimistic to as high as almost 44% in Morgan Stanley's bear market scenario. But shortly after, in 4Q, we see a very sizable rebound, leaving the 2020 year-over-year GDP contraction somewhere in the neighborhood of just under 4%. And this is obviously what Wall Street and equity market investors are thinking about. They are buying equities in anticipation of expected earnings, an economy that reopens. But that's accelerated stock prices for very weak earnings. And we'll look at just a minute. The price to earnings and some other metrics are very favorable given where we are with equity market values. And just a few illustrations, and this information is plastered across every single news media outlet, and I think we're all very well aware of how different countries are responding to COVID cases. China, Italy, some of the countries first affected experienced peaks in February and March, and they have been, at least recently, on the road to recovery. Now we're starting to see increased instances, new cases, and there's still some skepticism around whether or not this virus is truly contained. However, in emerging markets, Brazil and India, for example, we are now seeing a dramatic spike in cases. In healthcare measures, healthcare systems aren't nearly as robust in some of these emerging markets, and that could have a dramatic impact on perhaps not developed market equity, but emerging market equity, international equity, more generally speaking. The number of deaths, of course, or the spike has abated. We are no longer seeing the dramatic acceleration that we encountered in April and in May. Unfortunately, we still have a ways to go. The expectations, while still around 500 daily deaths, which is disheartening to say the least, is much more reassuring than where we were back in April. We seem to be able to accommodate some of these, or this crisis, a little bit more reasonably. We have more measures in place, and I think this trail has led to more equity market, or more willingness to take on risk within equity markets. The mortality rate, as we're beginning to collect more and more data, affects different age groups in different ways. And unfortunately, our older population appears to be much more susceptible. and we continue to collect more and more data. And this weighs heavily on the minds of investors, real estate investors in particular, is we see a specific demographic being impacted. Unemployment obviously was a highlight in the news. Just last week, we saw a dramatic spike in the number of unemployment claims, and that number I think was as high as almost 36 million. The number of new unemployment claims continues to trend downward as economies reopen regionally and perhaps even statewide, and folks are going back to work. The number that was released at the end of last week was 13.7%, far below expectations. April's number was around 14.7%. And there seems to be some sort of concern or challenge in the way that furloughed workers were accounted for in specific data sets. The April unemployment number was probably, and this is a U3 number, not a total unemployment number, was around 20% more realistically, and it's probably higher than where we were at 13.3% in the first week in June. But markets obviously reacted very favorably to that number. We saw equity markets regain all that was lost for a brief period of time, even though there was some speculation around whether or not these numbers are accurate. And just to illustrate some of the the sectors that have been more impacted than others, and this is really very intuitive, and I think probably metrics that you've seen already, but travel, leisure, anything related to really just travel, leisure, recreation, restaurants, hotels has been most significantly impacted. Unfortunately, that doesn't represent a significant weight of the overall workforce. It's probably somewhere in the neighborhood of 10 to 15%, but obviously that weighs very heavily on paychecks, household consumptions, uncertainty. And just to give a sense for the number or percentage of workers that are impacted, almost 60% of workers have been negatively impacted, whether it's permanent or temporary loss of their job or some sort of income hours reduced. 6% have seen hours increase. I think we've all read accounts of organizations that are hiring delivery drivers, folks that work at Amazon. There are some organizations and some sectors that have responded favorably, healthcare, for example, that have seen an increase in hourly wages, but hourly employee time. And then 35% have seen no impact to their overall working environment. At this point, most states have reopened. I don't know if they've completely reopened, but they have taken major steps to reopen their economies. Just 4 states, Illinois, of course, has been much more cautious, and New Jersey has probably been the most conservative, but has plans to open soon. And all of this leads to a very favorable market outlook, very favorable equity market outlook, as we see more and more states opening their doors and returning to business as usual. But I think the question that we all ask is, are we opening too soon? Are we exposing ourselves, our communities to a resurgence in the virus? Can we contain a second wave? Can we contain a third wave? In Texas, one of the states that implemented a phased reopening plan earlier than other states, has seen an increase in the number of cases. The moving average, or the 14-day moving average of new cases, hovered around 900 to 1,100, and there was a dramatic spike following a low point in late May. So we need to be mindful, or investors need to be mindful of what this can potentially mean for equity markets as a second wave potentially hits. We spend a lot of time talking about the shape of a recovery. Is it check mark? Is it U-shaped? Is it W-shaped? And all of this leads to a level of uncertainty that we just don't yet know. There's a lot of unknowns, as we'll talk about in just a minute, especially around the magnitude and swiftness of fiscal and monetary stimulus. So to illustrate sort of the slow road to recovery, really dependent on a couple of key metrics. One, a permanent vaccine or treatment program, to the extent that some sort of cure can be implemented that will alleviate many investors, many companies, and allow us to resume sort of life as normal. But until then, I think there's still an element of hesitancy. Economies reopening, as we've just talked about, that has a major impact on the overall optimism. And then, of course, fiscal and monetary stimulus. These have been key drivers in stopping the liquidity constraints, mitigating volatility, and allowing investors to adopt a more risk-on investment profile. And just to put some perspective into the size and scope of this particular stimulus program, the 2009 Recovery and Relief Program was about $800 billion. It was implemented about a year and a half after the first sign of financial distress, when markets started to crack. By contrast, we have now seen almost $3 trillion in fiscal or in monetary and fiscal stimulus. It represents almost 13% of GDP. And it has been implemented around 4 to 6 weeks after the first sign of distress. So we've seen a tremendous amount of capital flow into the American financial system, and other countries have followed suit. But the question remains is, what are the implications? The Federal Reserve has dramatically increased its balance sheet as they have implemented an unprecedented asset buying program. They are now buying corporate bonds, corporate bond ETFs, asset-backed securities, mortgage-backed securities at levels that we have never seen. And that has a positive implication in terms of smoothing volatility, giving some sort of backstop, giving some sort of credit backstop to corporations that are issuing debt. But we just don't know what the implications are surrounding $7.2 trillion in balance sheet assets in the Federal Reserve, which is 2 times what we witnessed following the global financial crisis, and almost 3 or 4 times higher than what we've seen at every period prior to that. This just leads to more and more uncertainty, and we just don't have answers. It's certainly helped to stabilize asset prices. When we think back to the most recent example 10 years ago, the expectation was, with this capital moving into our system, we should expect higher inflation. We should expect higher interest rates to curb that inflation. But that inflation never came. We never saw wage expansion. We saw a contradicting demographic shift that not forced more people out of the workforce, but more and more people left the workforce as aging baby boomers retired. And that probably offset some of the inflationary pressures that were set forth by fiscal and monetary stimulus programs 10 years ago. Those implications could be the same. We could expect more. We could expect inflation. But if there's other factors involved, and there always are, we may not see inflation. We may not see rising interest rates. The Federal Reserve did hike rates 9 times starting in December 2015, only to cut them 3 times last year and bring them all the way back to 0 in March. So how much stimulus and how much runway do we have? Japan, which is one of the most indebted nations in the world, has debt to GDP in excess of 200, and that's largely a function of their nationalized pension plan buying of Japanese government bonds. Most pensioners own Japanese government bonds. But our our debt to GDP is at one of the highest levels ever, near 160%. What are the implications for our credit quality or credit rating down the road? Will our debt be more expensive? This all leads to unprecedented areas and questions that we can only answer as we move forward and collect more data. On a more positive note, though, tracking recovery, we're starting to see small businesses rehire. We're starting to see households consume more. There was a dip early on, but it seems like there is a return to household consumption. Is the pain maybe is not as bad as it once felt, as folks are returning to work, as paychecks are coming back, and then job postings are starting to increase. The expectation is that 80% of those who lost their job will be recalled at some point. So what are the implications, or what were the implications, and what is the outlook for different capital markets? And we'll start with fixed income, equity, and spend a little bit of time talking about alternative asset classes. So fixed income, and more specifically government bonds, and cash, was really the only safe haven during the depths of this bear market. The flight to quality to short-term government fixed income, U.S. government fixed income, was the only safe haven. The Bloomberg Barclays Aggregate Bond Index, featured at the very top, is an investment-grade core fixed income index that's roughly 60% government securities. And it responded very well. Investors moved to government bonds and boosted prices. Year to date, very positive, and long-term returns are about what you would expect. By contrast, high-yield bonds, senior secured loans, or short-term or floating rate instruments issued by below investment-grade companies experienced a risk-off event. Not to mention, fixed income markets didn't function particularly well when liquidity disappears. Fixed income, unlike equities, are not traded on exchanges. They're traded by markets over the phone. As a result of some regulatory reform, the Volcker Act following the global financial crisis, large bulge bracket institutions had reduced their inventory. It becomes very difficult to make markets and offer liquidity when inventory levels have decreased. So not only did we see a risk-off event that impacted high-yield and senior secured loans, we saw liquidity completely disappear. When the Fed stepped in with measures around March 23rd, we saw the liquidity and volatility concerns abate. And then long-term government bonds, which has benefited from obviously the safety of the U.S. government as an issuer, but the benefit of rise or declining interest rates has seen a almost 21% return, which is absolutely unbelievable considering the credit quality and the relative safety. We don't expect a 21% return from long-term government bonds, one of the safest investments we can make. And just to illustrate maybe the point I made a few minutes ago, when we saw the depths of dealer inventory or just inventory collapse right around the middle of March, that's when the federal government stepped in with a backstop and offered support to capital markets. Liquidity quickly returned, and we've seen a recovery since. Returns since that trough for equity markets or for large cap is around 40%. And large cap growth, one of the most resilient sectors or sub-indices, is now in positive territory for the year. And thinking about this particular crisis compared to 2008, we saw a very quick recovery for below investment grade fixed income in 2009, and we're starting to see signs of that already. There's definitely a benefit to holding below investment grade fixed income in a client portfolio. There's higher yield, but with that comes increased volatility. But over the life of that particular investment, we should see returns that are in excess of what we would expect from simply core fixed income. And just to illustrate the same point by sector, the sectors in the underlying sectors in the high yield space that were most affected were energy, aerospace, anything again related to gaming and leisure. By contrast, communication services, technology, utility, food and drug all held up very well. And the same was true in equity sectors. So being mindful of how your underlying fixed income portfolios are constructed and allocations to sectors allowed you to either perform well or perhaps experience more losses than you otherwise would if you had exposures to some of these more impacted sectors. And just an illustration on 24 of why it is so important to stay invested over the long term, whether it's from 2008, the housing crisis, the shale crisis. Most high yield bonds are issued, or energy high yield bonds are issued in the high yield space to raise capital. So when we saw a sell off in energy prices, it affected the high yield market. But over the long term, bank loans, high yield bonds, below investment grade fixed income has outpaced and outperformed simply core fixed income. We think about the yields and the expectation from core bonds, which again are mostly government fixed income, relatively low, probably around 1.5%. We won't expect to see interest rates increasing anytime soon. I think the Federal Reserve has been very clear about their intentions, at least through 2022. And to the extent we do see rising rates, that will put more pressure on, or downward pressure on core fixed income. Moving on to equities, obviously we've seen a very dramatic and quick impact or return in performance from U.S. equities. But it's interesting to point out just the disparity in performance between the indices highlighted here, large cap and small cap, value and growth. And this is probably the biggest shock to me, perhaps you and some of your clients, is just how poorly value has performed relative to growth and how poorly small cap has performed relative to large cap. Those are some of the more undervalued assets relative to growth. Technology firms are at all-time highs, represent a tremendous amount of the overall S&P 500 market capitalization. And we would expect more undervalued securities to offer more protection during periods of an equity market decline. That was absolutely not the case. The more overvalued securities, the more expensive securities, technology names, biotech names tended to do better. And I think that caught me most off guard. I would have expected value to offer some sort of protection, and it just didn't. And we really don't have a great explanation other than the fact that most value stocks or many valued stocks hold economically sensitive securities like energy, which is undervalued, and they were more exposed to COVID-related sensitivity. Just to illustrate, kind of the point about areas of sensitivity. Energy most impacted, down 35% at the end of May. Financials also, followed by industrials and other cyclicals. By contrast, technology, materials, communication services, consumer discretionary, and staples all held up reasonably well. And just following the stimulus that was implemented, the last 2 months have been the best 2-month post-trough ever, which certainly creates more optimism and alleviates probably a sense of strain that's placed on me, my colleagues, and anyone that's responsible for client portfolios. And then valuations, with a renewed interest in equity market investing that's occurred in a relatively short period of time, despite the fact that outlook for earnings are relatively low. Forward PE across S&P 5, Russell 1 in particular, mid cap and even small cap, are at historically high levels, the most expensive levels that we have ever seen, which is especially, or creates some fear, because we don't know when earnings will return. We don't exactly know when there will be some sort of economic recovery. And are we poised for a more significant equity market sell-off? I think that the answer is that something we could expect to see, especially if there's a second wave. Stocks are very rich. Earnings are expected to be very disappointing. And a natural event would be a risk-off event. Also interesting is just the representation that large technology names, with the exception of Berkshire Hathaway and ExxonMobil, have in the S&P 500. 5 names now constitute 26% of the overall S&P 5. So how these 5 names perform drive the overall performance, which has been a stark contrast to what we've seen with smaller cap names, which I'll get to in just a minute. Smaller cap companies have been strained as a result of protectionist policies, fewer distribution channels, less pricing power, and large cap names really have performed well, especially these technology names here. The performance of just a handful of names really have been the most powerful. And if we see a sell-off or see some sort of reversal as a result of antitrust action or some sort of deconstruction of technology firms, we could see a dramatic negative outcome from S&P 500. And we look at this chart on an ongoing basis. Just the disparity between value and growth continues to get longer and longer. If we were to look at this same chart over a period of dating back to the 1930s, value stocks have outperformed. Buying a company at a discount relative to its traded value is a very sensible way to invest, but that has not been the case. Growth investors have outpaced value investors for the better part of the last decade, primarily because of the tremendous amount of stimulus. And here we are again with the same level of stimulus, if not more. What are the expectations for value versus growth? However, there is some sign that small cap stocks should outperform. We saw that following the global financial crisis and the dot-com bubble 1 and 2 years from the trough. There was noticeable outperformance of small cap stocks following the global financial crisis 2 years on, but it's certainly disappointed since then. I think that we recognize that there's an inefficiency that still exists in small cap markets. There's a premium that should be earned by investing in small cap companies, but there's also structural changes that have impacted that thesis. We see more and more companies staying private longer, going public at larger capitalization levels, and perhaps due to structural change, that small cap premium has just disappeared or has been mitigated in small cap public markets. Non-U.S. equities not spared either, unfortunately, and having a geographic diversification of equities really hasn't helped all that much, especially non-U.S. small cap. Emerging markets, non-U.S. small cap, are the most impacted when equity investors sell off. They de-risk portfolios by selling the most volatile names, and that's non-U.S. equity. We haven't seen the same level of recovery across developed markets as we've seen in the U.S., even though we've seen tremendous amount of financial stimulus in those markets. And just to put some context in the countries that have done well and done poorly, Brazil has been one of the worst performers. Switzerland, which is a very defensive country, a safe haven for a lot of investors, has been one of the best performers, as has the US. And then China, which seemed to experience this virus and then withdrawal much earlier than others, have been relatively safe places to be. In markets abroad, same areas of exposure across retail, restaurants, airlines, entertainment. Many of these economies are tourist economies that rely very, very heavily on travel and leisure, and that has a dramatic impact on emerging markets overall. Most countries and most central banks were very quick to implement some sort of rate cut to stimulate economies, as we can see on this particular chart. Developed markets, emerging markets were very quick to react and as ways to stabilize their economies, and I think that certainly did help. Had they not stepped in, liquidity concerns probably would have continued, volatility would have continued, lowering rates obviously is a way to mitigate overall fears. And then most markets also implemented some sort of fiscal stimulus, similar to what we've encountered in the U.S. Whether it's buying assets, supporting capital markets, all of that has been helpful in shoring up equity values and returning ability to withstand risk to equity investors. And then lastly, alternative asset classes. One of the benefits of alternative asset classes in client portfolios, whether it's institutional, personal, is just the ability to withstand volatility. Alternative asset classes are typically valued less frequently than equity markets. And as a result, lower overall volatility. Private equity, real estate, infrastructure are all asset classes that behave in different ways to traditional asset classes. And by including these asset classes in portfolios, we can see sort of less of a whiplash, better ability to navigate volatility, better ability to navigate storms like the one that we've just encountered. REITs, which of course are publicly traded and are exposed to the volatility of equity markets, but there's also private real estate in institutional portfolios. But it's interesting to see that the same sectors that we discussed in fixed income and in equities experience the same sort of challenges. Regional malls, they've already experienced some sort of deceleration. Retail investing is probably forever challenged. Hotels have been completely shut down. Shopping centers, student housing, as students have withdrawn from campuses and the outlook for returning to campus still remains in question. By contrast, apartments, manufactured homes, industrial space, primarily warehouses, life sciences, all of those are sectors that are a little bit more resilient. But as we think through kind of the next few years and employers re-envision their office space, we question what value or what is the value of real estate in portfolios. When we think about core open-end real estate, office represents almost a quarter of that. Will employers need more or less space? Will they occupy a hoteling arrangement where certain employees come in on certain days, or will they need more space to accommodate a full workforce and adequate social distancing? All of these issues, especially in real estate, are unknown. Senior housing, as I mentioned earlier, older citizens have been most exposed. Do we need to rethink the way that we invest in senior housing? Does senior housing need to be reinvented? What are the implications for multifamily living? Will there be an increased appetite for single family rentals? All of these lead to an element of unknown that shape the way we think about alternative asset class investing. Infrastructure, which we don't see in many individual portfolios, we see in some pension plans and larger institutional investors, but owning or investing in funds that have ownership rights for airports, midstream energy, toll roads, all of these are economically sensitive sub-asset classes that as consumption slows down, as households stop traveling, as households stop buying, we see less toll road activity as shipping becomes more constricted. By contrast, cell phone towers, water use, gas distribution, pipeline distribution, all of that tends to be much more resilient to GDP contractions and offset some of the volatility that occurs when markets seize up. And then lastly, private equity. Private equity is becoming more and more important in institutional client portfolios. It offers some of the most significant opportunities for growth, but it's also an equity investment. There are periods of write-downs we should expect to see in the quarters to come as private companies are revalued. However, as evidenced by the last two market downturns, we saw a trough that was roughly half the trough of public markets. U.S. buyout was down only 26%. Those marks came a little bit later. Those negative marks came a little bit later than public marks, which were obviously mark to market on a daily basis. And then the outperformance following represents some of the best vintage years ever. The opportunities to participate in private equity now will probably have some of the best return experiences for investors who stay their course and continue to invest in private markets. And just illustrated here, some of the best vintage, some of the best dispersion relative to public equity markets, or the Russell 3000, came in years following the global financial crisis, 2010, 2011, 2012, some of the best returning vintage years for private equity. Very difficult to time markets, even more challenging to time private markets. So to the extent that you're advising clients on private equity investing, the best path forward is to stay the course. Continue commitment amounts, continue to deploy capital at even intervals to make sure you're capturing very attractive buying opportunities. Prior to this, valuations have become very frothy. Then we expect a slowdown in overall transaction volume. Not much of a surprise. Fewer deals getting done, much more difficult to conduct due diligence on buying opportunities. Potential buyers or underwriters of certain asset classes or managers are not able to visit factories and companies on site. We're not able to visit investment managers on site. All of that leads to a slowdown in M&A activity, in new partnerships, new relationship forming. So this just leads to an overall slowdown in capital raising distributions. Nonetheless, still it creates a good opportunity to invest in new capital. And I think that leaves us with almost exactly 10 minutes for questions. Hopefully we have some, a lot on our minds, I'm sure. Don't know if we got any chats or any questions, but I'm happy to take some.
There is a question out there for you, Dave.
Where can I find that?
Can you convey any market expectations, observations, and how they are reflected in or pertain to any ICF investment program? Community Foundation.
Sure. Well, let's see. I think probably the most telling is from the chart on price to earnings and just how lofty and how expensive those metrics are. We have seen a tremendous amount of capital flood back into equity markets, driven almost entirely by stimulus, the Federal Reserve buying assets. And those are lofty valuations. If we see a second wave, I think investors will become very jittery and look to de-risk portfolios. I think very optimistic and hopeful that that's not the case, that we are on a continued trough upwards. But the expectation, the reality is that we are going to see greater economic contraction, probably prolonged periods of lofty unemployment, and a recovery that's just going to take a little bit longer. Expectation for for public equity returns this year, it would be great if they're positive, but I think that that's probably unlikely. Now, I wouldn't necessarily deviate from any sort of planned investment policy or asset allocation as a result of that. The best path forward is to always remain invested according to policy targets, because that could have been the bottom. We could have seen a bottom on March 23rd, but the numbers just aren't aligned with equity investors.
Mm-hmm. We have another question from Lewis. Based on the lagging nature of private equity and private credit, when would you expect to see write-downs, and to what extent?
Yeah, that's really interesting. And the write-downs we're starting to see now from 12/31 aren't nearly as low as we would have expected. And that's largely based on perhaps expectations for, future outlook. and perhaps maybe more favorable public market experience following the end of 331. I think private equity investors are reluctant to write down their books, only to write them back up as public markets have returned. So the short answer is, and perhaps it's emblematic of what we've seen during the previous two downturns, that the troughs are roughly half of what we expect in public markets. But those write downs are coming. They're not as significant as what I would have expected. Now, private credit's a little bit different. The investment period for private credit is shorter than private equity. Private credit basically sources returns from writing loans and being expected to be paid in full with some sort of interest. So to the extent that we don't see material defaults and continued payments in those credits, we wouldn't expect to see material write-downs. Both, private credit or organizations that are raising funds for private credit now are underwriting loans in a current environment, and they're able to get more favorable terms. There are some pools of capital where we can invest in existing loan pools, and we are seeing some marks that have been as much as 20%, but there's offsets to that, to the liabilities that make the NAV or the write down in the NAV not as severe. But those are coming. I think the best guidance would be half of what we've seen in public markets. But the fact that we've seen very positive outcomes in public markets since has led to a reluctance to dramatically write down portfolio companies. Not to mention that much of the private credit space is invested, or private credit and private equity space is invested in technology, business services, communication services, and these are all sectors that have been incredibly resilient. Mm-hmm. And that's helped offset some of that downturn as well.
Great. And Aaron has a big question for you. So looking at the big picture, what are the key lessons we should take away from this crisis? And how can we better position ourselves to do better when the next crisis comes? How's your crystal ball look on that one, Dave?
Wow, I think we're about out of time.
Yeah, look at the time.
So, I assume that question is kind of broader in scope than just markets, but I'll answer both, or try to answer both. From an investor perspective, we are always conscientious as stewards of capital, as fiduciaries, as committee members. We are all well aware of the risks that are involved with investing. And those risks can come in a variety of different forms. Most of the time they are economically related, but not always. Think back to maybe the oil crisis in the early 70s and other instances where we have been caught off guard by exogenous events. So always being prepared for outlier events, understanding how that impacts portfolios is part of our fiduciary responsibility. So I don't think, hopefully the community foundation wasn't too caught off guard by the implication in their portfolio, being diversified, being protected, being exposed or mitigating exposure to asset classes. Now, with respect to the broader picture, I think we've certainly learned lessons with respect to overall healthcare. We are a very reactive country. We can move nimbly, maybe not always as nimbly as we need to, but I think our ability to withstand a second wave is probably much better than it was before. We've collected a significant amount of data. We recognize that older populations are exposed and probably doing more to protect those particular or that particular demographic as a way to safeguard against any sort of overloading to healthcare systems. We also, Marquette works with a number of healthcare systems, and we saw, revenues deteriorate significantly as elective surgeries decreased and as more and more beds were occupied by people that were sick, and being able to accommodate that level of need is something I think has been addressed relatively quickly. Right. In Chicago, we saw instances of, McCormick Center being converted to healthcare, military boats docked offshore in Manhattan that really never needed to be used. Yeah.
Good answer. And our board chair, Scott Cernett, has a question for you. He says, hello. And as we have discussed in many of our investment committee meetings and also at the board level, just maybe sharing with the group how rebalancing is important, how we'll look at that as a community foundation. Maybe just share a little bit with the group about how Marquette and our foundation works together on a regular basis to have those conversations.
Sure. Hi, Scott. Thanks for that softball. Yeah, that's an important part of any sort of disciplined investment program, whether it's your own retirement, whether it's your clients, but abiding by the discipline that's set forward in investment policy is a critical way to maintain that goal allocation, maintain that goal return. The community foundation basically rebalances on an ongoing basis through capital flows, whether it's donations or charitable contributions that are made. Those are allocated to underweights, and we raise capital from strategic overweights. So we rebalance as a natural operating process. We have private equity capital calls. We are building a private equity program that's becoming more mature, where we take down assets from overvalued areas, whether it's fixed income when equity markets are down, or we take from public equity when public equities are up to fund our private equity program. But those, and it's a difficult thing to do, especially when we're in areas of uncertainty, but being disciplined, sticking to the investment policy, and rebalancing back to targets, especially in March, was the best way to boost returns. And those investors that did that were certainly rewarded. The Community Foundation maintained those goal allocations basically throughout this crisis, and we've benefited from that. So being good stewards, sticking to the investment policy is the best path during periods of uncertainty.
Great. We have time for maybe one more question if anybody has one. Otherwise, we'll wrap up. I don't see anything else in the chat box. If not, we'll go ahead and wrap up our conversation today. Again, we thank you for your continued support of our foundation. Thanks, Dave, for providing us with a plethora of awesome information to share, probably more than most of us can digest over a lunch hour, right? But we also just really want to thank you for the support that you provide us as a foundation, and certainly to the nonprofits that we support. As we've said, now more than ever, we really realize the great strength and the resiliency of our communities, and at the core of the nonprofits in our communities across our region really have been sharing and leading the way and connecting resources to really help those in most need in our community, providing those resources of food and shelter, safety, housing, employment connections, etc. So we just would again ask you and encourage you to continue to do your part. Encourage your clients to consider a charitable gift directly to a nonprofit or through our foundation, just really supporting the great nonprofits that are working so hard right now to respond. Reach out, share a note of thanks to a community partner. Everyone needs a little extra encouragement, I think, in these days, and volunteer if you can, and share a personal gift as well. But this pandemic certainly has literally affected each one of us, and especially our nonprofit partners in our communities. So we also want to say special thanks to our board members who were able to join us today, to our investment committee members who, again, continue throughout the year to share their valuable insight and information to help us make smart decisions as an organization. And we're very grateful for that. So as we close, we will look forward to our next professional advisory event. I believe it's scheduled for October 21st. Hopefully that might actually be in person, which sounds like a lovely idea, right? And again, we will be getting out and sharing all of the slides that Dave shared with us today. So I will go ahead and say thank you, and we wish you all a great afternoon and stay safe. Thanks so much.
Thanks, everybody.
Thanks, Dave.
Thanks,
Bye-bye.
Thanks, Dave.